Most people think a credit card is just a faster way to spend money you already have. It's not. A credit card is a short-term loan that renews every single month, and depending on how you use it, it's either one of the most powerful financial tools available to you, or one of the most expensive mistakes you can make.
I don't know how I'm going to pay all of these.
I'm going to show you every type of credit card in the US, how each one works, and at the end of this video, I'm going to show you a number that will completely change how you think about that minimum payment button. Stay for that. Let's start with the basics. A credit card is not your money. When you swipe a credit card, the card issuer, usually a bank, pays the merchant on your behalf, and you owe that money back to the bank. If you pay it back in full by the end of the billing cycle, you pay 0 interest. If you don't, the bank starts charging you interest on the remaining balance, and that interest compounds. That's the fundamental thing to understand before we talk about any specific card type. A debit card, by contrast, pulls directly from your checking account. It's your money leaving immediately. No loan, no interest, no credit building. People treat them like the same thing, but they're completely different tools. Now, let's get into the types. The first is a rewards credit card. This is the most common type for people who already have decent credit. Every time you spend, you earn points or miles that can be redeemed for things like travel, merchandise, or statement credits. The better your credit score, the better the rewards card you can qualify for. Premium rewards cards like the Chase Sapphire Reserve or the Amex Platinum offer serious travel perks. Airport lounge access, travel credits, hotel upgrades, but they also come with annual fees that can run anywhere from $95 to $695 per year. Whether the fee is worth it depends entirely on whether you actually use the perks. Most people don't, which means they're paying hundreds of dollars a year for benefits sitting unused. The second type is a cash back credit card. Instead of points or miles, you get a percentage of your spending returned to you as cash. A flat rate cash back card gives you the same percentage on everything, typically 1.5% to 2%. A tiered cash back card gives you higher percentages in specific categories like 3% on groceries, 2% on gas, and 1% on everything else. For most people who don't want to think about travel redemptions or point valuations, a good cashback card is the simplest and most straightforward way to get value from everyday spending. The third type is a travel credit card. These are built specifically around travel rewards, airline miles, hotel points, and perks tied to specific airlines or hotel chains. If you fly frequently with one airline, a co-branded airline card can make a lot of sense. You earn miles faster on that airline's flights. You often get a free checked bag, priority boarding, and sometimes companion passes. Hotel cards work similarly. You earn points faster at that chain and often get automatic elite status, which means room upgrades and late checkouts. The catch is that your rewards are locked into that ecosystem. Delta miles are only useful if you fly Delta. Hilton points are only useful if you stay at Hilton properties. The fourth type is a balance transfer credit card. This one isn't about rewards at all. It's about getting out of debt cheaper. If you're carrying a high interest balance on another card, a balance transfer card lets you move that balance over to a new card with a 0% introductory APR, usually for 12 to 21 months. During that window, every dollar you pay goes directly toward the principal instead of being eaten by interest. The catch is the balance transfer fee, which is typically 3% to 5% of the amount transferred. So, if you transfer $5,000, you're paying $150 to $250 upfront. That's still usually far less than the interest you'd pay by staying on your current card. Used correctly, a balance transfer card is one of the few legitimate ways to get ahead of credit card debt. The fifth type is a secured credit card. This is where most people start when they have no credit history or are rebuilding after financial problems. You put down a cash deposit, usually between $200 and $500, and that deposit becomes your credit limit. The card works like a normal credit card in terms of how you use it, but the deposit protects the bank in case you don't pay. After several months of consistent, responsible use, most issuers will either upgrade you to an unsecured card or refund your deposit. It's a slow process, but there's no faster way to start building a credit history from scratch. The sixth type is a student credit card. These are designed for people in college who have limited or no credit history. The credit limits are low, usually $500 to $1,000. The rewards are modest, and the approval requirements are easier to meet. Some student cards offer small incentives like cash back for maintaining a good GPA. They're not the most exciting product, but they serve an important purpose. They give young people a low-stakes way to start using credit responsibly before the stakes get higher. The seventh type is a business credit card. If you run any kind of business, even a freelance operation or a side hustle, a business credit card keeps your personal and business expenses completely separate, which makes accounting and tax time significantly easier. Business cards typically offer higher credit limits than personal cards, rewards categories that align with business spending like office supplies, advertising, and travel, and additional cards for employees with individual spending limits. To open one, most issuers will ask for your business name, your EIN or social security number, and some basic information about your revenue. You don't need to be a registered LLC. Sole proprietors qualify too. Now, here's the thing I want you to understand before this video ends, because this is the part that changes how people think about credit cards permanently. Every credit card statement has a minimum payment. It's usually somewhere between $25 and 2% of your balance, whichever is higher. And it's designed to look manageable. If you have a $5,000 balance on a card with a 24% APR and you only pay the minimum every month, it will take you over 15 years to pay that card off. And by the time you're done, you will have paid more than $7,000 in interest on top of the original $5,000. You will have paid $12,000 for $5,000 worth of purchases. The bank didn't steal from you. You handed it to them one minimum payment at a time. That's not an argument against credit cards. The right credit card used correctly, meaning you pay the full balance every single month, costs you nothing in interest, builds your credit history, and earns you rewards on money you were going to spend anyway. But the moment you start carrying a balance and only paying the minimum, the math turns against you completely, and it does so quietly every single month for years. Use credit cards like a tool, not like extra income. The people who win with credit cards are the ones who treat every swipe as if the money is already leaving their bank account. Because eventually, it will. If this video was useful, hit subscribe. There's a lot more of this coming, and it only gets more interesting from here. Thanks for watching. I'll see you in the next one.